Hey friend, Steve here with IBC Global. Today we're going to answer the question, which life insurance company is best if I want a whole life insurance policy for cash value? We'll cover several points, starting off with what to look for when comparing different companies and products. Then we'll go over a common trap that so many people fall into and how to avoid it. Then we'll discuss different companies and products that we're going to review in our analysis. And then we'll go over a case study of both a 50-year-old and also 60-year-old individual. And then we'll cover some additional considerations that are beneficial to be aware of when you're looking at different companies and products. So let's kick things off with what to look for. So when getting a whole life insurance policy for cash value, what should we look for? Kind of obvious. The cash value. Now, with that said, the specific product that we select is extremely important, meaning life insurance companies design different policies and different products for different purposes. I'll give you an example. If we look at MassMutual, one of the 4 major mutual life insurance companies, they have 8 different whole life insurance products. If we look at their Whole Life 100 product, that's one of the most popular products that's sold with MassMutual. This product emphasizes death benefit first and has the lowest internal rate of return, call it lowest returns on cash value, compared to other products that are offered by MassMutual. Whereas if you were to look at their 10-pay product, this product prioritizes cash accumulation and will have the highest internal rate of return on cash value when compared to other products. Now, the thing is, you can get this information from an agent that you're speaking with, and you can also get it directly from the life insurance company. So here's a piece from MassMutual that goes over their different products, and at the top, you can see which products are designed by the company for cash accumulation and which products are designed more so for death benefit protection. So if we were to look at the far right, we'll see the Whole Life 100 product, because this product is designed for death benefit first and cash value second. And you can see that if we were to compare all of the different MassMutual products and we paid the same dollar amount into all of the different products, you would see the lowest cash value with the Whole Life 100 product, particularly when looking at the non-guaranteed values. The guaranteed values do tell a different story. Whereas looking to the left, we'll have these 4 products. Now, what I have seen in terms of cash accumulation, particularly when we were designing policies for maximum cash value, is that the 10-pay is often number 1 and the 15-pay is usually number 2. We're going to take a look at the 10-pay in a moment. But with that said, this is a nice piece that I do like a lot that comes directly from the insurance company. And you can get this information from most insurance companies as well. Okay, let's talk about a common trap and how to avoid it. So a common trap is showing one company's worst product and comparing it to another company's best product, meaning the agent is doing that to you and you're not aware of it. So let me walk you through this exercise. We'll call this Agent Steve, pretending it's me, shows you company A and company B. And I say that I represent multiple companies. Now, company B offers multiple whole life insurance products, and company A only offers 1 or 2 whole life insurance products. Now, here's the thing. You, as the consumer, are not aware of this information. Specifically, you don't know that different products are available with company B. And even if you did know, you wouldn't know what they meant either. You would just take my word for it, the agent, that I'm going to show you the best option for cash accumulation. So I show you a comparison of company A and company B. Company A looks way better than company B. You say, let's move forward with company A. I say, sounds like a plan. I would do the same. But you were never shown the best product with company B. But then you later learn that company A paid me a significantly higher commission than what company B would pay me. So I used my knowledge to sell you a policy that made it look good or made it look as if it were in your best interest, but it really wasn't. It was in my best interest. This is a common sales tactic that I've seen practiced many times over the years. I'll give you a quick example. This is based on a situation I recently saw happen, actually. So here is a Mass Mutual Whole Life 100 product. This is for a 50-year-old individual funding $200,000 per year for a period of 5 years. Here, we can see his cash value. By the 5th year, he's paid in $1 million. He's got just about $980,000. Year 6, he pays in nothing, and he has more than $1 million. So that is his break-even point. So we've got this product first, and then second, we've got this guy. So this is an illustration with Penn Mutual. This is their accumulation whole life product. Same 50-year-old individual, same health rating, the same best class, and same funding. $200K per year for 5 years. There's the cash value. A little bit better break-even point. So when I compare these two side by side, what do I see? Let's take a look. The Whole Life 100 product. There we go. And there's the Penn Mutual product. Which one looks better? Well, up front, in year 1, I've got 167 with the Whole Life 100 with Mass Mutual and 160 with Penn Mutual. So Mass looks a little bit better initially, but as time passes, a different story is told. By the 10th year, you've got $1,310,000 with Penn Mutual and $1,219,000 with the Mass Mutual Whole Life 100. That's about a $90,000 difference by year 10. That's not a long time when we look at cash buildup or cash value buildup in a life insurance policy. If we look at it by year 20, the Whole Life 100, $1,982,000. Look at this. The Penn Mutual product, $2.28 million. Significantly more in cash value. You're talking several $100,000 more. So, which one would you pick? Probably the Penn Mutual product. Here's the thing though. What if you saw this after you started the policy? So here's a Mass Mutual 10-pay policy, which we know is a product designed for cash accumulation first, not death benefit first. Same $200K per year for 5 years. Look at this. We see more cash value up front, don't we? Let's take a look at the two side by side. So now we've got Penn Mutual and a Mass Mutual 10-pay. What do we see here? We see an earlier break-even point with the Mass Mutual 10-pay. If we go as early as possible, year 1, you're at 180 in cash value compared to 160 with Penn. So you've got an additional $20,000 in cash value. If we look at the 10th year, things are in favor of Mass Mutual, not Penn, like what we saw with the other product. And as time passes, Penn gets a little bit closer, but then eventually falls behind again. Mass Mutual is stronger from start to finish when we compare the cash value side by side. Both on a 50-year-old individual, both policies are maxed out with shrinking the premium as low as we could shrink it and just juice the cash value. So, a sales tactic to look out for, or the trap we don't want to fall into, is not being shown all of the options. A question you can ask any agent you're working with is the policy you're showing me the product that is designed for the most cash value with this insurance company? I would ask it just like that. You could even take it a step further and ask, what is the commission rate on this product compared to other products? Because the incentive for me with those two products I just showed, if I compare the Penn Mutual Accumulation Whole Life to the Mass Mutual 10-pay, a lot of people don't like to show 10-pays because the commissions are minimized. They're very, very low compared to more traditional whole life insurance products? I'd make 3 to 4 times the amount, probably a little bit more than that actually. If I run it through our commission grid, I'd make significantly more with that particular Penn product compared to the MassMutual 10-pay product. If I'm comparing it to the Whole Life 100, well, then the commissions with Penn and Mass will still be higher with Penn, but they'll be a lot closer. Another way to put it is that MassMutual Whole Life 100 pays a lot more than the MassMutual 10-pay. Anyway, you can kind of see what's going on here. Let's progress on. So, different companies and products that we're going to compare. We're going to look at 4 different options. 2 of them are the 2 we just looked at. So look at MassMutual's 10-pay policy. Why we're looking at the 10-pay is because we're focusing on cash accumulation, and the MassMutual 10-pay is one of their strongest products, short-term and long-term, for cash accumulation. Now, with that said, they have a total of 8 whole life insurance products available. So there might be a case where we look at different options, especially if someone said, hey, I might want to fund a policy longer than 10 years. Then we've got a Guardian 10-pay policy. From a long-term perspective, this product is going to deliver the highest internal rate of return on cash value compared to all other Guardian products. With that said, Guardian has a total of 10 whole life insurance products available. If someone wanted to fund longer than 10 years, I might look at a different option. I like their L95 product as it can provide very attractive upfront cash values and carries a low minimum premium. And I also like their Executive Strategies whole life insurance product for corporations that are taking out policies on their executives or high net worth individuals funding more than $1 million per year, because I have very strong early cash values and strong long-term cash value. With New York Life, we'll look at their custom whole life insurance product. They have 2 core whole life products available. Their custom whole life product, which is a product where I can customize the funding up front. If I want to fund 5 years, for example, I can set that funding period up front. It can also be 10 years or a longer period. And then the other product they offer is just a traditional whole life product. The premium is due until age 100 or something like that. It might be 121. And then we'll also look at Penn Mutual's accumulation whole life insurance product. They do offer one other product that is more designed for death benefit. It offers a high death benefit at a low premium. So the case study we're going to take a look at is as follows. First, look at a 50-year-old individual, then a 60-year-old individual. We'll look at the same funding for both of them, $200K per year for 5 years, which is a total of $1 million. And we'll also look at a pretty cool lump sum alternative. We'll look at that just for the 50-year-old individual. So let's take a look, shall we? We've got the numbers up on Excel, but they're all based on these illustrations. So we ran the illustrations for each product and then exported everything to Excel. I am going to go over the minimums and maximums for each of these policies. What I will say is when I go over the minimums, it will include the base premium plus the cost of the term insurance rider. And I did round everything off. But you'll see everything match these illustrations. And if you'd like to cross-reference and make sure everything on the Excel workbook matches these illustrations exactly, well, I just went through each of them so you can pause, go back and compare the numbers you see on Excel with the numbers you just saw on the illustrations themselves. Okay, let's take a look at our 50-year-old individual. So first, we've got the MassMutual 10-pay product. We're funding $200K per year for a period of 10 years. The minimum premium, $22,000. MEC limit, $200,000. And again, that minimum of 22 includes the base premium plus the cost of the term insurance rider. Break-even point, year 4. I've paid an $800 and I have more than $800,000. So I'm breaking even very early. Next, we've got the Guardian 10-pay product. Now, the one thing about Guardian's 10-pay product that I'm not a big fan of is that we do have to carry a higher minimum premium. What I mean when I say that is that their illustration software for all of their products except for the 10-pay product allows us to illustrate 10 times the base premium going into PUAs every year whereas the 10-pay product allows a maximum of 5x the base premium to go in PUAs every year. That's why the minimum is higher with the 10-pay product specific to Guardian. With that said, the break-even point, still not bad. Year 5 in this particular example. Next, we've got New York Life. As Frank Sinatra would say, I want to be a part of it. So with their custom whole life product, the base premium came out to about $53,000. And then with the term insurance rider, I rounded off to $58K. So upfront cash value, it's not that attractive. I might look at their traditional whole life product if I wanted more upfront. But the break-even point is year 5 in this example. So I am able to make up for that gap relatively early, meaning I take about a $40,000 hit up front, but I do recapture it by year 5, which is nice. And then lastly, we've got Penn Mutual, which is not one of your 4 major mutual companies, but their illustrations do look very attractive just whenever we're looking at whole life insurance. Notice I said illustrations, not necessarily real policies that have lived the test of time. So we've got the funding, $200K per year, break-even point, year 5. Which option gives you the most cash value? You could look at the numbers here. We can scroll down. You might go cross-eyed. I could do it like this. By year 20, who's the winner? Mass Mutual. You could scroll down. I want to go down to year 30. When he's about 80 years old, who's the winner? Still Mass Mutual. Let's look at an easier way. Isn't that better? So, in blue, specifically dark blue, we've got the Mass Mutual 10-pay. In light blue, we've got Penn Mutual. You will see that from start to finish, Mass Mutual is the winner. That is based on the current dividend interest rate with each life insurance company. Mass Mutual for 2025, 6.4%, Guardian 6.1%, New York Life is 6.2%, and then Penn Mutual is 6%. Dividend rates do not represent the true net rate, meaning our annual yield or internal rate of return will never hit the dividend rate. The dividend rate is a gross rate. But it also doesn't matter because we see Penn Mutual has a lower dividend rate than New York Life and Guardian, but via illustrated performance, they look better. Okay, let's progress on to the lump sum scenario. This will be pretty cool. So if I'm speaking with this individual and he says, hey, I like this and all, but I don't want to put my $1 million in over 5 years. That's too long. Can I get it in faster? If that was the case, I would gravitate toward Guardian because their products accommodate large first-year lump sum deposits, meaning I can keep my minimum premium low and start with a large lump sum. So what we've got first is the Guardian 10-pay product. With the 10-pay, I have my minimum here at about $45K, and the funding schedule is $500,000 in the first year, and then $250,000 years 2 and 3. After that, we pay nothing. We can keep adding money if we want to, but we're not in this example. The break-even point is very, very close to year 4. Remember in the example where we funded $200K per year for 5 years with the Guardian 10-pay, the break-even point was a clean year 5. So we have more cash value up front by condensing the funding over 3 years and starting with a large first-year lump sum. And you'll also see more cash value long-term when we compare this with the same Guardian 10-pay where we funded it level at $200K per year for 5 years. Now, if you looked at this and said, man, that hit up front, it's just not working for me. Yeah, I like the long-term performance, but I want to see more juice in the early years. That's where I might transition to this L95 product. Check that out. Pretty nice, huh? Break-even point, clean year 3, where I've paid in a total of $1 million and I have $1 million. And the first year cash value is just over $460,000. So I'm very cash rich right out of the gates. And if I want, I can continue to add money to this product, which is nice. I'm not forced to stop after 3 years in this particular example. So that's our 50-year-old individual. Let's progress onto our 60-year-old individual, and we're going to look at the same funding of $200K per year for 5 years, but we won't look at New York Life this time. Instead, we're going to look at that Guardian L95 product with more cash value up front. So first, we've got the MassMutual 10-pay product. Very similar to the 50-year-old individual, where my first year cash value, instead of 180, it's about 178. Break-even point, very close to year 4, and technically I'm cash positive by year 5, which is so sweet. Next, we've got the Guardian 10-pay. So here, very similar to the 50-year-old individual, where I break even at year 5. Then I've got the Guardian L95 product. Long term, this will lag compared to the other examples. So why would I do this? Well, if I like Guardian because of their PUA flexibility, which I'll talk about in a little bit, with the L95, I can commit to a lower minimum than what I would have with the 10-pay product. I also have more equity up front if I want to have access to more cash value earlier rather than later, like what I see with the 10-pay. That might be a reason to consider that option. We usually show both, and some people we work with split it, depends on their preference. And then we've got the Penn Mutual Accumulation Whole Life Insurance product. Whereas we get older, the Penn product, the break-even is sometimes delayed. And this is for a 60-year-old best class health rating as well. All across the board, they're all best class. So, which one has the most money? Let's take a look at our chart. Who's the winner? Dark blue, MassMutual, clearly ahead all the way through, which is nice. Light blue is Penn. So we do see that they lag further behind with the 60-year-old individual compared to the 50-year-old individual. But the other thing is that Guardian 10-pay closes the gap as time passes. And then the L95 is not going to keep up long term because the product's not designed for it. It'd be like me going back to the Whole Life 100 and including that in this chart. That would be even lower. So this is a nice comparison, at least I think it's a nice comparison, that just shows different companies and products and how to really look for the most cash value. So let's hit on some other considerations, and then I will give you my answer to the question, which life insurance company is best for cash value? So, other considerations when choosing a life insurance company and product. Here's the big one, PUA flexibility. So I included a video in the description that goes over 5 different life insurance companies and their PUA rider flexibility. To give you a quick sample, if you were to look at Guardian, they're a company that allows you to commit to the minimum base premium. If I attach a term rider, I can pay up to 10x that base premium per year. And in the first year, I can add a lump sum as high as 50x the base premium, provided I have the right term riders attached to prevent a MEC or modified endowment contract. MassMutual, you can design similarly, where I can fund up to 10x the base premium in PUAs per year. But if I use their 2 PUA riders, their AILR, which stands for Additional Life Insurance Rider, and also their LISR, I'll find that it's typically most convenient for me as a policyholder to make adjustments 1 time per year on my anniversary date. And I go through different companies and products in that video as well. Historical performance. I included a couple of videos that go through this. This is huge, and it often is the #1 source of buyer's remorse in the life insurance industry. Specifically, what I mean when I say that is individuals move forward with a life insurance policy based on the projection or the illustration. And then when we look at that illustration, it shows huge returns, a great cash value growth, and it delivers a lot less. Expectations were set here, reality was down here. How do you prevent that? Because as an agent, Everything can be done on our side to ensure the best possible results, but there are things that we just can't control. The insurance company has a lot of control over everything. So what I'm big on is selecting companies and products that can provide proof that they don't do that. So if I go back to my days working at the executive benefits firm, where my role was designing policies for corporations, the conversation of historical performance always came up. Like the illustration was like, who cares? Like we want to know, does this company have a track record of delivering? And the only companies that we could get consistent proof of performance from, and this is still the case to this day, just as I'm always looking at historical performance, are the four major mutuals: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. That is where I've seen the strongest actual performance. Another consideration, starting a policy with a lump sum. We talked about that a little bit with Guardian. They're very attractive. I did include a video that provides some lump sum examples as well. And then the last consideration is agent commission. So going back to the exercise we went through earlier, if life insurance company A pays me an agent $20,000 more than what company B might pay me, as the agent, I'm incentivized to promote that insurance company. No matter how I spin it, what I say, that is the truth when I'm paid literally $20,000 more. And in my experience, what I have seen, going back to the historical performance, is companies like the major mutuals who can provide proof of strong historical performance do pay the least commissions or the lowest commissions in the life insurance industry. Meaning I can often get more juice out of a contract with other companies compared to what is available with the four major mutuals. And I'm not saying small companies are bad. We use some small companies on occasion, and I have relationships with people who work at smaller companies, and I like them. One company in particular has worked with me on trying to obtain historical performance. We're still working on it, but my point is, I have seen the big guys deliver the most value, and they do pay the lowest commissions. So I hope that this video was helpful. I'd love to hear your thoughts and any questions, comments, thoughts. Please leave them in the comments below. And if you like this video, I included another one over here.